Okay, let's unpack this. This week is shaping up to be, well, absolutely pivotal for anyone watching the stock market,
Yeah.
setting the stage for what could be a wild ride or maybe a smoother sail. We're diving into the sources you've shared to give you a clear roadmap of exactly what to watch for.
And it's fascinating, isn't it? The market is at a genuine crossroads. We have this really robust earnings season behind us,
Yeah, really strong.
but it's pushed valuations to, historically high levels.
Uh,
And that leaves the market acutely vulnerable.
right. Very sensitive.
Yeah, any negative catalyst could have a big impact. So this deep dive, we'll look at the specific data, the events that decide if we stick with that soft landing story
Roar.
or face more of a stagflationary scare,
Hmm.
which is not what anyone wants.
Definitely not. So our mission for you today,
Hmm.
cut through the noise. We want to pull out the key signals from the economic data, the corporate earnings, and really help you understand this sharp clash of ideas, the bull case versus the bear case that's going to shape things.
We'll connect the dots.
Exactly. And see what the different outcomes might mean for different sectors and, for your own view of the economy. So where are we starting from? As we head into this critical week, what's the backdrop? What's the market position right now?
Well, the foundation is surprisingly quite optimistic. It's really been driven by that strong second quarter earnings season.
Yeah, you mentioned that. The numbers were impressive.
They really were.
Hmm.
I mean, 90% of S&P 500 companies have reported, and get this, 81% beat their earnings per share estimates.
Wow, 81%.
Yeah. It's led to an 11.8% blended year-over-year growth rate for the S&P 500. That's 3 quarters in a row now of double-digit growth. Shows real corporate resilience.
Okay, but there's always a but, isn't there?
There is, and it's a big one.
Oh.
This optimism have a cost. The S&P 500's forward 12-month PE ratio, price to earnings, is now up at 22.1.
Which is high compared to...
Well above average. The 5-year average is 19.9, the 10-year is 18.5. So 22.1 is rich. I mean, a lot of good news is priced in. Frankly, there's very little room for error.
And here's where it gets really interesting, right? That high valuation means the market's kind of teetering.
Exactly.
It's built on this belief in a soft landing. Fed tames inflation, no recession. Any negative surprise could just challenge that whole idea.
And that's precisely why this week feels like an inflation gauntlet. It's not just one day.
Yeah.
It's a series of critical data releases that build the full picture of inflation risk. You have to see it as a multi-day story. The full picture won't really emerge until Friday close.
Like a multi-act play unfolding. So Act I, Tuesday, what's the main event?
Act I, no doubt, is Tuesday's Consumer Price Index, the CPI, 8:30 a.m. Eastern. This sets the tone.
And the market's expecting.
Mostly assuming continued disinflation, that smooth glide path down to the Fed's 2% target. But, yeah, some recent PMI data actually suggested selling prices picked up pace, maybe the fastest since August 2022. That could throw a wrench in the works.
Yeah. So how does the market react?
Well, the algorithms, the initial flash trade, will react to the headline year-over-year number. But the institutions, and definitely the Fed, they pivot fast to core CPI.
Stripping out food and energy.
Right. Volatile stuff. They want the underlying trend. And then they dig even deeper into the sticky parts, like shelter costs and what some call supercore inflation.
Okay, supercore. Explain that. Why is that specific measure, core services excluding housing, why is that so critical for the Fed?
It's critical because these costs are the stickiest, the hardest to bring down. They signal genuine, entrenched inflation, often driven by wage pressures here at home, not just global supply chains.
Ah, okay.
That's what the Fed really watches for long-term policy. So any upside surprise there in sticky or supercore, that would have a really big hawkish impact on rate expectations.
Raises the question, are prices really easing or are they maybe heating up again?
Exactly. That's the core question Tuesday tries to answer.
All right. But the story doesn't end there. Act 2 is Thursday, the Producer Price Index, PPI.
Precisely. Thursday, 8:30 a.m. Eastern again. PPI is the crucial validation or contradiction of whatever CPI told us.
So CPI is consumer prices. PPI is wholesale. Business costs.
Exactly. It measures the cost pressures businesses face before things hit the consumer shelf. Think of it as inflation in the pipeline.
Okay, so if CPI was hot and then PPI comes in hot.
That really amplifies the fears. Suggests rising input costs are definitely getting passed through. But if PPI is cooler, even if CPI was a bit high, it might temper the negative reaction. Maybe suggest those pipeline pressures are easing.
Got it. And what do analysts look for within PPI?
Beyond the headline, they'll look at core PPI that excludes food, energy, and trade services. And they'll look at the split between goods inflation, linked to global stuff, and services inflation, more about domestic wages.
And a surge in services PPI would be?
Particularly concerning for the Fed, suggests broader economic heating.
Okay, so Tuesday CPI, Thursday PPI, then Friday, Act 3, the consumer's pulse. What's that involve?
Friday, we get two key things. First, July retail sales at 8:30 a.m. Eastern. Then, the preliminary August University of Michigan consumer sentiment and inflation expectations at 10 a.m.
Shifting from pure inflation to growth and how people are feeling.
Right. For retail sales, the number everyone watches is the control group.
Control group.
Yeah, it's a refined measure that strips out volatile things like cars and gas. It feeds directly into GDP calculations, so it gives the clearest read on core consumer spending.
And what's the expectation there?
Consensus expects about a 0.5% month-over-month increase. A strong number helps the soft landing idea. A big miss. That sparks recession fears.
And the Michigan survey? Sentiment matters, but you mentioned inflation expectations.
Those are paramount for the Fed, the 1-year and 5-year expectations. Any sign those are becoming unanchored to the upside.
Unanchored? What does that mean practically? Why is the Fed so worried about that?
It means people, consumers, businesses actually start believing inflation will stay high regardless of current data. And that belief changes behavior.
Like demanding higher wages, raising prices more readily.
Exactly. It becomes a self-fulfilling prophecy, making the Fed's job incredibly difficult. It would be a profoundly hawkish signal if those expectations jump.
So, connecting it all. Investors really need to see this as a whole week's worth of information, layering on top of each other.
Absolutely. The full inflation picture only comes into focus by Friday's close.
Okay, beyond the big economic numbers, we also have some really key earnings reports. Not just company news, but like real-time checks on different parts of the economy.
Exactly. They'll either confirm or maybe contradict the story the macro data tells. Take Monday, before the market opens. Barrick Gold, ticker GOLD.
A materials company.
Right. So their results, their outlook, can set an early tone. We'll listen for what they say about rising costs, labor, energy. That's a real-world inflation read.
So their comments on costs could be an early warning for CPI, like a canary in the coal mine.
It could be, yeah. For input costs, definitely. And also, what they say about gold demand can be a clue about institutional risk appetite right before CPI hits.
Interesting. Okay, then later on Monday, after the close,
we get Kankier Group, ticker CAVA, fast casual dining, a good bellwether for discretionary spending, especially middle to upper income folks.
So are people still eating out? Are they paying higher prices?
That's the question. We'll look at same-store sales, traffic, and especially pricing power. Can they pass on costs without losing customers? Their restaurant profit margin is also a key indicator for that whole sector.
A good read on consumer resilience. Then fast forward to Thursday.
Thursday morning before the bell, Deere & Co., ticker DE, farming and construction equipment, a vital window into the real economy.
What are we expecting there?
Well, EPS is expected to be down from last year, maybe $4.62 versus $6.29. But the key is management's commentary. Farmer sentiment, their balance sheets, willingness to invest in big equipment, and any weakness in construction or forestry would signal a broader industrial slowdown. Their full-year guidance is critical.
Okay. And then Thursday after the close, a really big one for tech. Applied Materials, AMAT, feels like a major test for the AI rally, doesn't it?
It absolutely does. AMAT makes the equipment needed to make advanced semiconductors. They're right at the heart of the tech supply chain.
So the focus is?
The durability of AI-driven demand. If they report strong orders, a robust outlook, it powerfully reinforces that whole bullish AI story.
But if they're cautious?
If they're cautious, especially on AI-related stuff, it could make investors question those high semiconductor valuations. Could trigger a whole sector rethink.
So for the listener, how exactly is AMAT a proof point for the AI rally? What are the ripple effects if they are cautious?
Think of it like selling shovels during a gold rush. If AMAT isn't selling as many shovels, maybe the gold rush isn't as big or lasting as people thought.
Ah, got it.
If they see strong demand, it means companies are still spending big on AI infrastructure. If they're cautious, it suggests maybe that spending is slowing or delayed. That directly hits the valuation case for chip makers like NVIDIA and others. We also watch their China sales and demand for non-AI chips, like auto and consumer electronics.
Right. So lots of layers there. Now, it's not just the numbers. It's also what the Fed says about the numbers. No FOMC meeting, but officials are speaking.
And their timing is key this week. It gives us a before and after picture relative to CPI. Monday, 1 p.m. Eastern, Vice Chair Michelle Bowman, she's generally seen as hawkish.
So her speech before CPI sets a baseline mood.
Exactly. The market will listen closely for any worries about sticky inflation, any hints about future policy. Her tone will definitely color how Tuesday's CPI is first received.
Okay, then the big one seems to be Wednesday.
Wednesday, 1 p.m. Eastern again, Chicago Fed President Austin Goolsbee. Moderated Q&A. This is arguably the most important Fed event.
Why him specifically?
He's a voting member considered a moderate dove. And critically, he's the first Fed official to react publicly after Tuesday's CPI data.
Ah, the first reaction. So if CPI was hot.
Does he brush it off or sound genuinely concerned? If a known dove sounds hawkish, that's a powerful bearish signal.
And if CPI was cool.
Does he sound relieved? Or still cautious, saying one data point isn't a trend? His level of dovishness will directly sway expectations for the September Fed meeting. Huge for bonds and stocks.
So let's say CPI is hot. What's your gut feeling? How does the Fed really shift for Jackson Hole? Are they ready to go higher for longer if the data forces it? Or is there still wiggle room for Powell to sound softer?
That's the billion-dollar question, isn't it? And this week's data basically writes the script for next week's big events. The FOMC minutes on August 20th, and then Jackson Hole starting the 21st.
So this week dictates next week's narrative.
Completely. A week of hot inflation, strong growth. The market braces for a hawkish Powell at Jackson Hole. Cool inflation, weak growth. Traders expect a more dovish tone. This week's trading is really a battle to control that narrative.
Which brings us right to the core. How all these pieces, inflation, earnings, Fed talk, create totally different market outcomes. Two distinct paths, right? A real confrontation of ideas. This feels like the aha moment.
Exactly. And remember the context. Strong earnings, but stretched valuations. So let's paint the bull case first, the Goldilocks scenario.
Okay.
This validates the soft landing story. It starts with a cooler than expected CPI Tuesday.
Good news on inflation.
Confirmed by a tame PPI Thursday. Then solid retail sales Friday, showing that consumers hanging in there.
And on the company side.
Strong AMAT earnings confirm AI is real, and Deere signals maybe the industrial slowdown isn't so bad. It's stabilizing. And to top it off, Goolsbee, the dove, sounds clearly dovish after seeing the data.
And if Goldilocks wins, the market impact.
Big relief rally. It justifies the high PE ratio. You'd likely see a broad rally, probably led by the NASDAQ Q as bond yields fall. Tech, consumer discretionary, maybe industrials, real estate rate-sensitive sectors do well. Optimism gets validated.
Okay, that's the sunny side. Now the bear case, the stagflationary scare.
This is the damaging one. It starts with hotter than expected CPI Tuesday. Inflation's sticky. Confirmed by a hot PPI Thursday, businesses still passing on costs. Then you get weak retail sales Friday. Ouch. Growth is slowing, even while inflation stays high.
That dreaded combo.
Exactly. And maybe Deere cuts guidance, confirming a deeper industrial slump. On the Fed side, Bowman sounds hawkish Monday, and Goolsbee, the dove, sounds genuinely worried about inflation Wednesday.
So that stagflationary scare, high inflation, slow growth, why is that mix so bad for the Fed, for the market? Are there any tiny silver linings if that happens?
It's the nightmare because it traps the Fed. They want to cut rates to help a weak economy, but they can't because inflation is still the bigger problem.
Puts them in a bind.
A terrible bind. It attacks valuations from both sides. Higher rates push down PE multiples, and slowing growth lowers earnings forecasts. Double whammy.
Leading
a significant risk-off move. NASDAQ would likely get hit hardest. Money flees to defensive spots like consumer staples, utilities. The dollar probably strengthens as a safe haven. Silver linings. Very hard to find for the broad market. Maybe some commodities or inflation-linked bonds hold up, but it's fundamentally bad news.
Wow, a really stark contrast. So digging into sectors a bit more, how do different parts of the market react specifically to these two scenarios?
Okay, let's break it down. First, technology XLK. Hugely sensitive to inflation and rates. Hot CPI means higher yields, which crushes tech valuations, especially growth stocks.
Unless
AMAT somehow delivers a blowout report. That could offset some pain. But a miss from AMAT plus hot CPI, that's a recipe for a sharp tech sell-off.
Okay. How about industrials, XLI, and materials, XLB?
Well, inflation might give a temporary boost to someone like Barrick Gold, but really, these sectors depend on global growth. So signals from Deere are key. A weak Deere report confirms those manufacturing slowdown fears, hitting industrials hard.
Makes sense. And the consumer sectors, discretionary, XLY versus staples, XLP.
Their relative performance tells the consumer health story. Strong CVA, strong retail sales. Favors discretionary people are still spending on wants. Weak results. Money rotates defensively into staples people, buying necessities.
Got it. Finally, financials, XLF, banks and such.
All about yields and the yield curve shape. Hot CPI pushing yields higher might help bank profit margins initially.
Right.
But if the yield curve inverts deeply short rates above long rates, that screams recession risk, which is bad for banks due to loan losses and slower lending.
So a really complex web of interactions there. This week truly feels like an inflection point then. The inflation data, the earnings, it's all going to set the narrative for months. Understanding these opposing bull-bear cases and how each data point fits seems absolutely crucial.
It really is. And knowledge is most valuable when you can apply it, right? This week's data gives sophisticated investors the inputs they need to position themselves. The outcome shapes everything. Immediate reaction, Jackson Hole expectations.
It forces a moment of truth.
Exactly. A moment of realization about the market's true underlying health, cutting through the noise.
So, for you, the listener, here's the provocative thought. Which path, Goldilocks or stagflationary scare, do you think the incoming data will point towards? And how does that shape your own understanding of the economy, your approach to the market? Don't miss these insights as they unfold. Subscribe now for the fastest updates on the deep dive and stay ahead of the curve.